Hey everybody, welcome to Bank to the Future live episode 101. We're actually going to be doing the 101 of crypto lending due to the disaster that's happened over the last few months in the crypto lending market. So today is all about the future of crypto lending. We have been off at BF Live because for the last year, we've really been in license application mode. And we're at the end of some of those license applications. So we really hope to be making some important announcements over the coming weeks and months ahead. If you didn't see it, we've been making a few announcements after my trip to go see the president of El Salvador, and also a recent acquisition that we've completed on SALT lending, pending definitive terms and also regulatory approval. And so we thought it would be appropriate, really, with the crypto lending market in such disarray, to cover a first principles look at what I think the future of crypto lending looks like. So I prepared a few slides, and as always, I like to go back in history as a complete money geek and look at what we have already learned from the traditional markets so that we can apply it to hard money in the Bitcoin-backed crypto lending markets as well. So the way we're going to do is slightly different. Normally in the past, we did our half hour and then we did half an hour Q&A using Slido. Well, today we're going to be using Twitter Spaces. So after this, I'm going to be interacting with you. It's a lot more interactive than Slido, where you can come on and ask a few questions. I've been doing a lot of those recently and they've been uploaded to the Simon Dixon YouTube channel. But now that we are getting ready for our next set of companies and pitches, the last update we did was during the Luna crisis. And since then, there has been the crypto lending platform crisis as well. So I'm just going to check that my slides are working, and I'm going to share my slides. So let's come off camera. And Zod, can you see my slides?
Yep, I can see it. Can everyone else?
Awesome. Okay. All right. Well, everyone will let me know if it's not showing up. Let's jump straight in. So as I said, this is on the future of the crypto lending markets. And I like to go back to first principles. Now, remember, the last time that we had a financial system like the Bitcoin financial system that was built upon hard money was pretty much towards the end of the 19th century. And we had a lot of innovation throughout the 20th century. And those lessons teach us a lot. And the first lesson that led to really the whole financial crisis debt cycle that we're in right now was a switch from hard money to fiat money. I call it the hard money to fiat swap. And it consisted of a few events. The first events that really cemented it, as we said, the financial system, all fiat currency was backed by gold, and banks were just simply a safety deposit box for your gold. And then they started to issue receipts for your gold. And as they started to issue receipts for their gold, we started to have the birth of the fiat currency system through several events, whereby if you tried to get your gold from that receipt, there was not enough gold to cover those receipts in what we call credit money. Credit money is simply more money existing than actually backs it up. And really it accumulated into the 1907 panic. In the 1907 panic, we had United Copper, where banks were trying to corner the market in United Copper. They were all lending money from the depositors and lending more and collateralizing in order to invest in the stock market to try and corner the market and manipulate the price of copper. That went wrong, and when it went wrong, it led to a panic on several banks when the Knickerbocker Trust essentially went insolvent as a result of the leverage. And then that had an effect on the different banks, and everybody started coming to try and claim in their receipts for gold. Essentially, there was no cash, there was no gold. Everybody tried to get their notes. The notes didn't exist, and it ended to a mass run on lots of different banks. And so this fella here in the top right, called JP Morgan, he came along and said to all these different banks and said, hey, I've got cash, I've got gold, I'll lend you some money to give confidence in the bank, but in exchange for that, I would want to buy your company for pennies on the dollars for almost completely free. And JP Morgan became the powerhouse, and JP Morgan became the lender of last resort and started to monopolize the banking industry in the United States. That has recently been used, and we'll go through that in the recent markets when we do the parallels. Then using this power, in 1910, a bunch of bankers and politicians met on Jekyll Island, and they decided to put together a replacement for JP Morgan called the Federal Reserve. And so they implemented a way of getting taxpayers and central banks to control the system to print fiat currency when this is needed so that you pay through inflation, and have the government back the system so that you pay through tax as well. That was designed in 1910, and then in 1913 it was implemented with the implementation of the Federal Reserve Act, using what they learned from the Bank of England, which learned from the Dutch Empire and the British Empire, and this launched the beginning of the American Empire and the dollarization of the world as there was a war. And in that war, in 1914, we had World War I. At the end of the war in 1918, it was negotiated at the Paris Versailles Treaty that the losers, Germany and its allies, would have to pay America and its allies, which consisted of Russia, America, UK, and they had to pay the equivalent today of $442 billion in gold, of which most of it, with the fall of the British Empire and the rise of the US Empire, with the US funding much of the military and being less affected, ended up with much of that gold in the Federal Reserve, so that the US became the most important economy. Several innovations came through, and it was all backed by gold at the Federal Reserve. Then it entered into a bull market. We had several crashes in between, entered into the Great Depression of the 1930s, when everyone was speculating in the epic 1929 crash. And in 1933, the Roosevelt, the president at the time, introduced several reforms, one of them which was FDIC, Federal Deposit Insurance Corporation, which said that in order to prevent more bank runs like happened in the 1930s, we've got the Federal Reserve, but now we need deposit insurance as well. And so that was a bunch of banks that would come together for the system. But if the insurance didn't cover the banks that were going bankrupt at the time or insolvent at the time, then it would be backed by the US the US credit rating and the United States government. And essentially, there was the foundation of the complete fiat currency to gold money swap. All the gold ended up in the coffers at the Federal Reserve. They made it illegal for Americans to own it. They had to hand it in for initially $20 and then $35 of banknotes. And all the gold ended up in the Federal Reserve, and they successfully swapped everything for fiat currency, essentially, backed by the lender of last resort, the Federal Reserve, and deposit insurance, FDIC. Innovation one. So that was the setup in order to prevent some of the situations that are happening in the current crypto lending market. So what was innovation number two? Well, innovation number two was to take all of that and lay the foundation of the government bailout structure so that the taxpayer could pay. So the Federal Reserve would create new money, and the banks had the license to create more money than they had, which would cause inflation. And then the governments could bail out the system, creating this thing in economics we call a moral hazard. And a moral hazard is essentially when you know that the government can back it, you can take higher risks, and you can take higher risks based upon the belief that the government will bail you out. So how did they do that? Well, in 1944, after the Second World War, the monetary system needed to be renegotiated. So John Maynard Keynes, which was a British economist, came along and said, we should create a global digital currency called Bancor. And that was rejected. And in favor for that, the US government and Hoover managed to negotiate that everyone would come off the gold standard and simply have a dollar standard. And the dollar would remain because it had all the gold, or a big supply of the gold, and it had the fact that it was illegal to own gold in America. They would promise to back their dollars by a fixed amount of gold, and it went to the next design of the system. So now everybody came off the gold standard, convertible to dollars, and dollars promised to be backed by gold. The problem is that started to decrease the gold supply of the Federal Reserve. So in 1971, in order to save the system as we started to enter into the 1970s inflationary period, the gold standard was removed, and President Nixon said, in order to save America, everybody hand in your gold, and it's going to be, we're going to remove the gold standard as well, and we're going to move to a full fiat debt-backed standard. Why can we do that? Because we've got the Federal Reserve, which is the lender of last resort. Everyone can pay through inflation. And we also have the government bailout, FDIC, as well, backed by the credit rating of the US government. So those that held deposits can have some kind of guarantee. So let's remove the gold standard, and banks go out, lend as much as possible. Let's create real estate bubbles, and let's get everyone's pensions moving and the stock market moving and recover the markets. Then that led to a massive bubble in the real estate markets, massive amounts of debt being printed, and banks and savings and loans organizations getting ever more reckless based upon the government bailout, which resulted in FSLIC that you may not have heard of. You probably heard of FDIC, which guarantees the large commercial banks, but FSLIC was the guarantor of the deposits of the savings and loans. Now, there was a savings and loan crisis because of stagflation throughout the 70s and 80s. Interest rates were put up, were pretty high. And that was due to some of the Volcker reforms that was trying to become more, less reckless. But it led to the savings and loan crisis. And we saw for the first time that an organization like FDIC can actually go bankrupt. FSLIC, went bankrupt because it was insuring more than it could handle. And when those banks simultaneously went bust, essentially the government bailout had to be called in, and taxpayers paid, and it cost taxpayers hundreds of billions of dollars in order to bail out the system. And FSLIC was bailed out by FDIC. And if you look at FDIC today, it can only handle approximately 1% of bank deposits that it's actually insuring. So if more than one major bank goes bust, it doesn't cover the insurance, and you have to move to taxpayers paying through the government bailout. So obviously this then led to our next bull market, where investment banks came along and they innovated how to sell lots and lots of mortgages to your pension. That led to a stock market boom. It led to the subprime crisis, where banks could just sell it off those mortgages, sell it to your pension and hedge funds. And we ended up with the Lehman Brothers situation. So September 2008, Lehman Brothers goes into Chapter 11 bankruptcy. And Chapter 11, again, we've learned from this, is essentially a restructuring, reorganization process that many of the crypto lending institutions are experiencing right now. And so within Chapter 11, there was some real shenanigans because of the government bailout process, where JP Morgan, the winner of the 1907 panic, essentially received a loan and a government lender of last resort loan from the Federal Reserve, because they designed part of the system. And the Federal Reserve then started using that bailout money in order to acquire public stock companies to the detriment of shareholders that owned companies like Lehman Brothers and Bear Stearns. So the Federal Reserve decided not to bail out Lehman Brothers or Bear Stearns, but instead it went into Chapter 11 bankruptcy, which is a good process. It means that you let the free market determine how to repair it. But JP Morgan, being JP Morgan, instead borrowed money from the Fed, who received a bailout, and then used it to acquire Lehman Brothers for pennies on the dollar, with Bear Stearns rather. And then Nomura Bank and Barclays Bank ended up being the beneficiary of Lehman Brothers, who were also given government bailouts as well. So that was the 2008 system was more of a free market solution, but funded by government bailouts where they were picking the winners and losers. But the Chapter 11 reorg was one of the biggest reorgs in financial history. Essentially, the shareholders in Barclays and Nomura benefited from the demise of Lehman Brothers, the loaning of the government bailouts was all that made it slightly corrupt. Then we had Innovation 3, so that recovered the market slightly, but the hangover from that led to the equity bail-in. So I'm just trying to outline from history the different models so that we can understand what potentially comes next in these markets. So Innovation 3 was the equity bail-in. And this came about from the Greek debt crisis. The European debt crisis led to a really European ECB bailout that had a lot of austerity measures, but led to a 50% haircut in those that owned Greek debt and that were lending money to the Greek government. Then that took a couple of years to see its way through to one of the largest holders of Greek debt, or one of the most exposed rather than largest, which was the Cypriot bank. So in 2013, there was about $120 billion of deposits at these Cypriot banks, and about 60 billion of it came from wealthy people in Russia that had formed an alliance with Cyprus due to some of the regulatory nature of the Cypriot financial system. And so that was looked upon as an opportunity to bail in the bank and make the shareholders take the 50% haircut and make those that had over $100,000 in deposit shareholders in the banks. And so this was the bank bail-in model. Again, it was a combination of crony capitalism combined with political, but at least used a free market solution for the 2013 bank bail-in. So those are the different things that made up, and obviously that then led to innovation number 4, which is digital hard sound money. In 2008, obviously we had the Bitcoin white paper, and then after the Bitcoin white paper in 2010, Bank to the Future launched and created a securities business whereby people could invest in Bitcoin companies that made Bitcoin more useful so that people could trade. And we started to change and look at how we could rebuild the system based upon digital hard sound money. Now, the Bitcoin was created as a way for people to own their own money, spend their own money, and have a hard money fixed supply and a fixed emission. So then we started funding many of the different companies by allowing the Bitcoiners to invest in the equity of many of the companies that built our industry. And we built out our secondary market so that people could pre-IPO look at trading those as well. And this led to Innovation 5 during the Bitcoin bailout model. The Bitcoin bailout model was really as a result of 2014 when Mt. Gox, Mark Capellas, bought an exchange from the creator of the XRP cryptocurrency Ripple that had 80,000 Bitcoin missing from it when he bought it without the disclosure. And then that led to a bit of a Ponzi scheme where everybody had balances, but it didn't. Those were essentially credit money, just like in the 1907 panic. And there was several hacks and incompetent practices due to be the first mover. And also another exchange called BTCE, which was processing many of the exchanges from Bitcoin that came off the Silk Road. Which was originally, ironically, arrested in Greece more recently, where he was hanging out after the Cypriot financial crisis. And in 2014, essentially 850,000 approximately Bitcoins went into a Japanese bankruptcy proceedings because they only had about 200 and 250,000 Bitcoins. I won't tell the whole story, but essentially they dollarized the claims. And it got bailed out by the fact that Bitcoin went on to become a multi-billion-dollar asset class and moved later into the $1 trillion. But 8 years later, several hard forks that led to additional money. It essentially got a Bitcoin bailout. People that valued their wealth in Bitcoin didn't receive all their Bitcoin back, but in dollar terms, it moved out of bankruptcy just to the increase in the price of Bitcoin. But it was a really, really bad, disastrous situation. Then we started to see different types of innovations around blockchain bailout. So innovation number 6 was when in 2016, a bunch of people that were part of the Ethereum Foundation separated off from the Ethereum Foundation and tried to create the first use case for Ethereum, which was claiming that you could have a decentralized venture capital fund and therefore it was not a security because the community would be deciding through what was known as the DAO, the Decentralized Autonomous Organization. And in 2016, the whole thing blew up, it got hacked, and it was a disaster that led to hundreds of millions of dollars that had been invested in the DAO, causing a lot of the original creators of Ethereum to lose a lot of their ETH that they got from one of the most successful ICOs. Now, because of the people that were there, they were able to lobby the community and reverse the chain. And so they did a blockchain bailout, where essentially they left the old chain behind and called it Ethereum Classic and created a new chain that didn't contain the transactions that were invested in the DAO. And people started to sell their DAO tokens for pennies on the dollars, and there was an arbitrage there because everyone that had Ethereum ended up with Ethereum Classic, and we ended up with the first blockchain bailout, proving that because there is some kind of centralization with the Ethereum Foundation, that you can lobby it and you can reverse the chain, explaining the difference between Ethereum and Bitcoin and the DAO and the importance. And then this got attacked by the SEC, and they defined that these tokens are securities. And then that started into innovation number 7. So 2016 was a pretty eventful year. We went into the equity bail-in. So this is where Bitfinex, a company that I'm a shareholder in, they were hacked for 119,000 Bitcoins. Rather than following the Mt. Gox process, they essentially issued a token that was convertible into equity, and people could convert that token into equity on BnkToTheFuture. And they implemented a successful bail-in where the funds were dollarized. They bailed in, everybody ended up shareholders in Bitfinex, and the community recovered it through equity. They started trading again. The price of those shares went from a bottom of 30 cents to a peak of $16, and hundreds of millions of dollars in dividends, and all the profits from the 2017 bull market was paid out to those shareholders. So that was really the first bail-in model that came from that. At the same time, we entered into, we went to a conference called Satoshi Roundtable, where a guy called Eric Voorhees, who was the first to be slapped for creating a Bitcoin-based security, and then the SEC saying that you can't do that when he funded Satoshi Dice, one of the first Bitcoin gambling sites, sat down with a gentleman called Sean Owen at a conference that I was at, a private conference. And the idea of being able to lock up your Bitcoin so that you could borrow against it was formed through a company called Salt Lending in 2016. And this was the creation of the collateralized lending model, where people, based upon hard money, could lock up their Bitcoin and they could over collateralize, i.e. they left more Bitcoin so that if the price crashed, you could borrow dollars, and then if it crashed, that collateral could be sold, and then on the other side, people could receive some yield in exchange for that, and the model was born. This led to the 2017 ICO bull market, where essentially companies started launching tokens. I invested in Salt at that time, and we had Celsius that came along and launched a token. BlockFi didn't, but it launched without a token. And also Voyager came along, and we had the growth of these markets. The problem was they kind of left regulations behind. They forgot about the securities part. So really that led to the SEC crackdown. They cracked down and chose Salt to crack down on, and they spent years and years acquiring the licenses, negotiating with the regulators around how to settle the situation. but the SEC let other companies grow really big without cracking down on them. And we ended up the situation where regulators essentially picked the companies that they wanted to take down and let the other ones grow, and then come to the situation where we are now. So the final few slides I have before we go into the last part on the future, is I presented this slide to many of the crypto lending platforms. I said in 2017, we had the ICO boom. That was cracked down by regulators, where they essentially tried to say all these tokens are securities. That led to the sideways market, but then we moved into the DeFi boom. I said that the DeFi boom, if it's done via these centralized companies, will lead to a DeFi crackdown, which corrected the market. Then you'd end up with these having to comply with securities laws. Then the centralized platforms came along, and you had the yield boom, where everyone was locking their money up in the yield platforms. And I said that this would lead to the yield crackdown as regulators decide and determine that these things are securities. And so the SEC then started investigating all those platforms. Then we learned about a couple of models, and I was forecasting back then, around about 2023, I don't think we'll have that now, in 2024, you'll probably have the next wave, which would be a securities boom market based upon these trends. So around about 2020 now, we started contacting Celsius, and we launched what we called the Retirement Plan B program, which was guiding people on how to diversify. So you can go from the cycle of spending, savings, investing, and contribution, and the different buckets, and guiding people through that process. And we started to create a security law compliant version in partnership with Celsius. We spent a couple of years on that. Then suddenly 2022 came along, and we had what we covered in the last episode of BF Live, the Terra Luna crackdown. So then we start to get the lessons of what we look for the future of Bitcoin and crypto lending. So Terra was backed by essentially a token. And if that token became illiquid, then you had to sell that token. That would crash the token, and it started to depeg as people started to take advantage of the trade on that stable coin. There's no dollars backing the stable coin, and essentially $40 to $60 billion of value just disappeared in a really, really quick time frame. There were a couple of companies that were really exposed to that. One of those was Three Arrows Capital, which was a hedge fund that had to take a huge hit. As interest rates up and Bitcoin started to crash too, the Luna had to sell all their Bitcoin in a rush. This created systemic risk in the collateral. Some of the trades they were taking on Grayscale started to reverse, and they ended up with a $2.8 billion that they owe to their people as they moved into bankruptcy. At the same time, we had FTX that came along and said, BlockFi is exposed to 3 Hours Capital. Why don't we do the JP Morgan strategy? So Sam Bankman-Friedman came along and said, I'll be the JP Morgan. Let's lend to BlockFi and figure out how to acquire the company for pennies on the dollars. And BlockFi was negotiating with the SEC, and therefore had a fast track to get the SEC license and fix the securities part of their business. I'm going to be moving over to Twitter Spaces to take your questions right after this one. I've got about another 5 minutes, so I'll probably be 3 minutes late over there. And so we saw the model of the 1907 model of JP Morgan being implemented to success, and BlockFi essentially is now FTX and has to get that securities license with the SEC, and they're filing their S1s right now. Voyager and Celsius moved into Chapter 11 bankruptcy, which means that they get the opportunity to do what Lehman Brothers did, which is reorg and find another company that might be able to take it on. Under either they can get a reorg and they can get that signed off by the courts as long as they can fix some of the things that we share. Or it would have to be taken on by another company that had those assets. But this time, I think we should be fighting for not the FTX strategy, but issuing equity like the Cypriot bail-in model, where at least the victims that were haircut end up with equity in the companies that might be able to reopen and create a model a bit like the Bitfinex. So combining the 1907 model, but rather than one company ending up with everything, combining it with the bank bail-in model where the depositors and victims end up with the equity, and then combining it with the Bitfinex model where you can have a potential recovery through increase in value in that equity. And so that brings us to where we are today in 2022. In order to support that at Bank to the Future, we made a recent announcement that we have entered into a negotiation. We're finalizing the terms to a definitive agreement pending regulatory approval with Salt Lending because they've now settled with the regulator. The idea is by combining the work that we've been doing over the last 10 years in securities law compliance with the work that Salt Lending has been doing for the last 6 years in figuring out how to do the compliant and risk model in the lending market, you could end up with what I think the future of crypto lending looks like, as well as a solution for any of those reorgs if they can't get out of Chapter 11, so that we can try and create a similar scenario to what we successfully did in the past several times with the Bitfinex one. So the final section before we move over to Twitter Spaces, where we take your questions, is what does the future of crypto lending look like? Well, as I said, those companies that hold a lot of Bitcoin and a lot of ETH, I think if we end up with a situation where they move into liquidation, it's going to have a systemic nature on the rest of the market, and we'll enter into an extended bear market phase like we did with Mt. Gox, where a lot of those Bitcoin and ETH have to hit the market, and we end up with a lot of people that lose billions and billions of money in their life savings. Not a good result. So I believe that a reorg is something that we are going to have to see to avoid that scenario. Either they can do it themselves, or they can go into a company like BlockFi or Bank to the Future that has got the securities and lending side covered because they've been working on it. Obviously, FTX has acquired BlockFi. BlockFi haven't got the license yet, but they've got to do it in order to maintain some of their equity in what's happening with FTX. You also need to de-risk the model for the future from what we've learned. We've learned that stablecoins that are not backed by dollars don't make good collateral. It cost Binance over $1 billion, which fortunately they had enough in order to bail themselves out, but that could have systemic risk on everything else, like it did with 3 Hours Capital, that then had systemic risk on all the other institutions that were not over collateralizing. So the lesson is over collateralized and good collateral. Basing things on a very illiquid coin, like they did in Celsius in some cases, and like they did in Luna, can have really, really catastrophic effects on the bank run and solvency of that company. Ethereum has completed its merge. We'll see what happens with this, if there's any splits or anything after that, like with the DAO. And so it no longer really needs to fall into the lending model. It can, but it will probably move into the staking model. And so therefore, pristine collateral is really left with Bitcoin, where you've got to manage volatility risk, and the dollar-backed stable coins, one which is exposed to the US system, and the other that is less exposed to the US system, that have different types of risks. So that you can basically, if the collateral goes wrong, you can back it by the dollars that back those stable coins. Then you can take all the other more exotic stuff and comply it with securities laws. And in securities laws, as we've been doing for the last decade, investors have to understand the risks. They can invest and they understand that they could lose all their money because they're taking higher risk. And you end up with all the disclosures and transparency that's required in order to take greater risk, and then you don't end up mixing your savings with your investing. And I'd like to point you to a couple of resources to understand how to manage those risks, because I believe the entire community next has to relearn. So yesterday on my YouTube channel, Simon Dixon, I released this video on how you as an individual can recover from financial disaster based upon going through the cycle of separating your spending money from your savings money, from your investing money to your contribution money. I'd love for everybody to check that video out if you haven't checked it out already, because that is where you can understand where this fits in your bucket when planning out your future strategy. I do not believe this is a good time to move away from the market. Obviously, that may be a choice that you do, but this is where genuine wealth is made from relearning, re-risking, and changing those regulatory structures to build the next wave of what this industry could look like through some of these reorgs as well. And investing in the industry during these times are the times when the maximum wealth is made, having been involved in this industry right from the beginning and seen those as well. So at Bank to the Future, we look to try and support those reorgs, try and create a solution that can allow for it and relearn and create the education that can support people in that relearning process. And so with that in mind, briefly, I'll go back to the camera, but I'm going to take as many questions as we can. Head over to my Twitter account at Simon Dixon Twit, and you will find an AMA there where you can join, and I'll be looking forward to interacting with you directly. Next week, in our next episode, a BF Live episode 102. Let's see if I can get the camera on. Okay. BF Live episode 102 will also be bringing in Sean from Salt Lending so that we can discuss many of the product opportunities when you combine both the compliant securities model with the compliant lending model, how that can have an impact on different types of investment products by combining both debt and equity and all the potential that comes from that in the future of this model. So we're going to pass that one over for the next episode of Bank to the Future Live. If you would like to get a notification for that, then please, if you enjoyed this video, hit the like button and share it with others that you think could learn from the last century of innovation in the traditional markets and how it applies to the future of the crypto lending markets. Share it with them. Subscribe to the Bank to the Future YouTube channel where we go over more content for investors. Hit that bell symbol and hit all, and you will get notified as we go live in the future. So now I'm going to head over in a couple of minutes to that Twitter space, and you can ask your questions and we'll interact on many of the exciting opportunities from this disastrous situation and how we turn that into something that supports the victims and really brings the next phase of growth to our industry. So I hope you enjoyed that. That's going to do it for episode 101 of Bank to the Future Live. I'll see you over on Twitter Spaces. Always remember, you're alive at one of the most interesting and exciting times in financial history. Some people have got really hurt. Others have done really well. And I want to make sure that you stay on the right side of that change and use this opportunity to rebuild from any kind of financial disaster that you may have experienced as well. So check out that video and I'll see you over on Twitter Spaces. Peace.